Okay, so debt to equity is important for loans, but why else is this ratio important? A business is financed by either debt or equity, money invested by owners, or a combination of the two. Using debt financing is riskier for a company than using equity financing. As the proportion of debt financing goes up, the risk of the company also goes up. That's why calculating this ratio is important, particularly for the owner. Investors look at the debt to equity ratio when considering a company to invest in. A higher ratio implies the level of risk a company has, so it helps investors in deciding whether or not an investment is worth investing. Owners can also look at the ratio to demonstrate the competition in the market compared to smaller businesses. Let's hear more about the importance of the debt to equity ratio from an expert.
Now let's talk about our debt to equity ratio. Now, couple components of that entire statement. The debt. This is the amount of money that the business owes to a financing institution or to private individuals. So it is money that is owed out to others. Equity is the amount of money that a company has based on what their prior income, their net income or net profit or loss is, as well as any contributions or additional funds that have been put in. Of course, we always go back to our accounting formula of assets equals liabilities plus owner's equity. You could also say it's assets minus liabilities equals owner's equity. And so those are formulas that we constantly are looking at and thinking about. So as we are looking at this particular ratio, the debt to equity ratio, what we're looking at is what is the percentage of debt versus the equity in the organization. Now, what we are looking for here is how much debt do you have to run your business? When you are looking at it, sometimes people will call it a leverage ratio. Basically, if you have somebody who is buying assets or is operating their business and they're using a lot of debt to do that, then they can be highly leveraged, meaning that they're in a lot of debt. And so what does that look like? It's not always a bad thing. Many businesses operate that way, but of course there needs to be the income and the money coming in to make sure that that can be paid. Now, the way that the debt to equity ratio is calculated is obviously total liability over the shareholders or stock equity there. And that's what we're looking at. And when we look at this, we aren't able to necessarily say, this is the good number, this is a bad number, this is too high, or that is too low. It really depends on the industry and the history, the experience of the owners, and so on and so forth. It's also important that if the company is in some circles, in some situations, they will say that if you don't have enough debt, that means that the equity is being used to finance the business. And again, the converse is true where we were using too much debt to finance the business. So there's lots of different ways to fund growth and to fund operations in a business. But using this, and especially using this on a trend, what was it this year versus last year versus the prior year, month to month potentially, and so on, really gives you an idea of what that looks like, if it's going in the trend or the direction that you're wanting it to go or that the business is wanting it to go. But again, it's all about financing the activities of the business and coming up with that ratio and deciding what that ratio ought to be and moving that client, helping them understand that so that they can move in the direction that they need to be going in.